All right, let's dive into one of the most exciting and, let's be honest, kind of confusing innovations out there right now. It's where Wall Street is smashing right into the world of crypto, and it's called tokenized stocks. Now, this tech promises to completely rewire how we all own and trade shares in the world's biggest companies. But the big question is this a real revolution or is it just hype? Let's break it down.
Just think about that for a second. Seriously. No more waiting around for the opening bell on Monday morning. You see some major news break over the weekend, and you can act on it right then and there. That is the core promise of tokenization. It's about turning traditional stocks into assets that move with the speed and, the flexibility of the digital world.
So, what are we actually talking about here? Well, at its heart, a tokenized stock is basically a digital IOU for a real share, and it lives on a blockchain. This means instead of your ownership being just a line item in a brokerage account, it's a token in your digital wallet, all governed by a smart contract. It's a fundamental shift.
Okay, so that's the big idea, but you know how it is with any new tech, right? We've got to separate the sales pitch from what's actually happening on the ground. So first, let's look at that big, shiny promise. And you have to admit, the dream they're selling is pretty compelling. A world where markets never, ever sleep, where anyone on the planet can invest in any company they want, where trades settle in seconds, not days. The whole idea is to cut out the middlemen, slash the costs, and make it so that literally anyone can buy even a tiny slice of a super expensive stock. Sounds great, right? So how does this magic actually happen? How does a real share of, say, Tesla become a token you can just trade around? Well, it happens in 4 really crucial steps. First up, an issuer has to set up all the legal groundwork to make sure it's compliant. Second, and this is so important, the actual shares are bought and locked away with a trusted, regulated custodian. Then the digital tokens are created or minted on the blockchain. And finally, those tokens can be bought and sold by verified investors. But, and this is a big but, here's the first major reality check. For a lot of these supposedly revolutionary features, traditional finance has kind of already caught up. You want to buy a fraction of a share? Yeah, your brokerage app probably does that already. Lower costs? Commission-free trading is pretty much the norm now for us retail folks. 24/7 access? Okay, maybe not fully there yet, but with pre-market and after-hours trading getting bigger and bigger, we're getting pretty close. So if it's not just about these convenience features that we're already starting to get anyway, what is the actual unique advantage here? What can tokenization do that traditional finance just plain can't replicate? The answer really comes down to one word: composability. This is the big one. It's the idea that once a stock becomes a token, it can be plugged into the entire world of decentralized finance, or DeFi. It stops being just a static asset that's sitting in your account and becomes, well, it becomes like a programmable financial Lego brick you can build stuff with. And this composability, this Lego brick idea, it unlocks a whole new set of financial tools. For instance, you could take your tokenized stock and actually use it as collateral to get a crypto loan, or you could add it to a liquidity pool and start earning trading fees from other people. All of a sudden, a passive investment becomes a productive, active asset. This is the true value that traditional brokers just can't offer you. Okay, but before you get too excited and start looking this up, we need to talk about the single most important and, frankly, the most misunderstood part of this whole topic. Because what you think you're buying might not be what you're actually getting at all. And this is the absolute crucial point. That term, tokenized stock, it gets used as this big marketing umbrella. But underneath that umbrella are products that are fundamentally different from one another. Many of them don't give you any actual ownership rights in the company. You're just making a bet on the price. The source material we analyzed for this puts it perfectly, highlighting that this is a source of significant potential investor confusion. And the risk isn't just about the stock price going down, it's about not even understanding what it is you legally hold in your hands. Okay, this table really lays it all out, so let's walk through it. There are basically 3 models you absolutely need to know. First, you've got the derivative model. Here, you don't own the stock. Not at all. You just own a contract that tracks the price. So what's your main risk? The platform that issued it going bust. Second is the tracker certificate. This is a debt instrument. You're not a shareholder, you're a creditor. Your risk is tied to the solvency of the special entity that created that certificate. And then finally, there's the true digital security. This is the only one where the token represents actual legal ownership, with voting rights, with dividends, the whole shebang.
And here, your main risk is just the company's performance, just like a normal stock.
So this all brings us to this really fascinating paradox. Blockchain is always sold to us as this trustless technology, but when you try to apply it to real-world assets like stocks, you find out that trust hasn't really been eliminated at all. It has simply been moved. As one analysis we read points out, you're just swapping your trust in a highly regulated financial institution for trust in a newer and often much less regulated crypto company that's acting as the issuer or the custodian.
And this creates a fundamentally different risk profile. In traditional finance, risk is spread out across a whole chain of regulated players. But in the tokenized world, it's often concentrated on just a few entities: the platform that made the token, the company holding the real shares, and the exchange you're trading on. If any single one of those fails, the whole thing can just collapse. So, with all these challenges, everything from misleading labels to these really concentrated risks, where does the tokenized stock market even go from here? Well, despite all the hurdles, the financial projections are massive. The market for all tokenized securities is forecasted to grow to nearly $9 billion by 2032. So clearly, Wall Street is betting that these problems can and will be solved.
But getting there is going to require hitting 3 really critical milestones. First, there just needs to be enough buyers and sellers to create deep, liquid markets. Second, the industry has to agree on standards so these tokens can move between different blockchains and we don't end up with a fragmented mess. And finally, and this is probably the most important one, regulators all over the world need to establish clear and consistent rules of the road. And that leaves us with the final question. When you really peel back all the layers of technology and hype, are we looking at a genuine evolution in how we own things? Something that makes markets more open and more efficient? Or is it, at least in its current form, often just a clever repackaging of old risks in a new, shiny, and much less regulated wrapper? The answer to that is probably going to define the next decade of finance.